All right, so let's get my notes here. Proposal strategies. I don't think I've done this in a while. So, and I think it's really come more to focus for me because I've been out there in the field. And I tell you what, man, I feel really on my game with regard to products, with regard to proposal strategies, how to take care of clients finding pain, um, because I'm doing everything that I'm teaching you, and I'm not doing everything that I should do. Like obviously with this other client, that was more of a rapport issue that I should be better at that. And so I'll mess up too. What the heck? It's always recoverable though. I learned from it. But so let's talk about what I do in the home or what, and this really helps me. And this isn't before the pain finding process. After doing the bond and rapport, when you're finding out about them. So this is sort of the about you slide. Well, this is the about you slide, and this sets me up for finding their pain. And so what I do, and I've talked to some of you out there this past week about it, is I'll turn the lead over, and then I'll put a T box. Okay. Okay, I put the T box, and on the left side of the T, I put Joe, and he's age, let's say 47, and Mary, and she's age 45. Okay, and then let's say it's a mortgage protection lead. So the mortgage protection lead, let's say it's a $100,000 mortgage, 30 years, and ask what the mortgage payment is. And let's say the mortgage payment is $800 a month. Okay. So it kind of gives me sort of like a profile. And then I ask them, so what is your household income, Joe and Mary? Just ballpark it for me, just round numbers. So I want them just to estimate it. And so I'll get the annual income, let's say it's $32,000. So I put their income right there. I don't know, it just seemed like a good place to put it, sort of like that's the need they're trying to cover, this is the income they have to cover it. And it just sort of developed like this. I know a previous big agent that you talked about using a T-graph. And what this does is helps me figure out who's got the major problem if someone died. So laying it out here like this really helps me diagnose what their situation is. So after putting the household income, then I ask, okay, Joe, of that $32,000, how much of that do you make? And so let's just say he makes $24,000. So I put that here. And then Mary, she makes the rest of that, which is what, $8,000? Maybe she's like a part-time help at daycare. So 24,000, 8,000. So that's about 30%, 25% of the income is what she makes. So that's how I kind of note it. So 8,000 is about 8 times 4 is 32, right? So I'll kind of my own credit notes. That's about 25% of the income, and then his 75% of the income. And so I draw a line, and I go, okay. So Mary, when Joe dies, I say when. So Mary, when Joe dies, and I'll do this. I'll kind of mark it out. So it gets messy. So when Joe dies, how much of that 24,000 goes to you? And like in the case of a retired couple, maybe some of it does go to her. Like maybe 12,000 of it, or 800 a month, goes from his Social Security to hers, or whatever. It could be something like that. But I want to make sure. So when Joe dies, does any of that money or any part of that income go to you? And she'll probably say no because they're young. They're not retired yet. Okay. Oh man. So your income goes down by 75%. So how are you going to live on 8,000? Are you going to be able to make this mortgage payment on 8,000 a year? I mean, I'm starting to get into the pain questions. Really, is what's happening now. I go, okay, Joe. So let's say Mary's next out of the picture. Does any of her 8,000 continue to come to you? Because who knows? It could be, maybe she's on Social Security or whatever. And he'll go, no. Okay, so on your 24,000 a year, can you still make that mortgage payment? He might say, well, things would be really tight, but I could probably make it. So when they use words like tight, okay, so describe tight for me. Does tight mean you can't do things for your kids? Does tight mean you still can eat and have a roof over your head? Does tight mean you can't have cable? Like, describe for me what tight means. As well, I might have to pick up a part-time job. Okay, I just want to know what tight is for you. So when it comes to pain finding, you need to really don't accept what I call wishy-washy words. Okay, wishy-washy words are non-specific words that end up faking themselves out and then ends up faking you out, thinking that you've drilled for the pain. That's where the pain begins, is tell me what tight means. Define that for me. Describe how hard it's going to be for you to make it. Married, describe how hard you can't make the mortgage payment. So what else are you going to do? Are you going to have to move out of the house? Oh, yeah. Where would you go? Would you move in with your mom? So you're making it highly unpleasant. So you're talking about Xing these people out. You put an X through them, man. You want to be demonstrative about it. You want to be dramatic about it. Like the X is here. It's like this, okay? They're not around. Okay, so that's sort of my drilling pain even before you get to the pain slide. So I find out all the other stuff on the about you slide. I talk about 401ks, and any other life insurance that you might have in force, which is not work insurance. Oh, when they say, well, I have 3 times my salary at work. Okay, so that's about 90,000. Okay, great. Most of our clients that buy mortgage protection also have their work program so that they can protect their spouse's income, their family's income. Okay, so this is where you differentiate life insurance and work insurance from mortgage protection. Okay, and you do it by most of our clients that buy mortgage protection also have their policies at work. They also have life insurance. All that is designed to protect income, not designed to protect the mortgage. Okay, so what you're doing is you're totally reframing life insurance and mortgage protection. Okay, you're making it different. Because if you agree, well, yeah, it's all life insurance, and they think, well, I already have life insurance. So you're trying to differentiate it. And it is a differentiation. There's a difference with a distinction. Okay, life insurance protects income, mortgage protection protects their mortgage. Okay, yeah, most of our clients have life insurance, that protects income. So what you've done is you've reframed what they think is mortgage protection with mortgage protection takes care of the home. In the event you die, we make your family viable so they can stay in the home. Okay, so that's how you push that objection aside by differentiating life insurance with mortgage protection, right? So once I figure out this and I get all their other information where I can possibly serve them with tax-free retirement, annuities, well, I'll probably be able to roll an annuity unless, when they say, well, you have 401k, how much of that 401k was rolled from a previous company? Okay, because this information is employer, how long did you work there? If they say I'm at AK Steel and I've been there for 5 years, oh, okay, so where did you work prior to AK Steel? I worked at Appleton Paper. Okay, great. So when he says you have 401k, when you ask, do you have 401k? They say, yeah, I have about 150,000 in it. Okay, the 150,000, how much of it did you roll in to AK Steel's program from Appleton Paper? If he says about 100,000, great. So you know that you have 100,000 that you can move into an annuity. See, because you can move money from a 401k that was rolled into their current employer's 401k program. So they have that 100,000, they can move into something else. All right, so that's how I find out that information. Okay, so I get all this stuff over here, then I put Mary's, employer, how long, does she have a 401k? Okay. Okay. Does she have any life insurance, etc.? So I want to know the picture. So this is the picture. And then I want to know, okay, so tell me about your health, Joe. Are you on any medications? Yeah, I'm on high blood pressure medication. Okay, when were you diagnosed with that? Back in 2001. Okay. Any other medications? Cholesterol. Okay, great. Okay, when were you diagnosed with that? Around the same time, 2001. Okay, what other medications? Acid reflux. Okay, how long have you been taking that? Since 2009. Okay, cool. Any other medications? No. When was the last time you used any cigarette products? I've never smoked. Okay, so I put non-smoker. Okay, so that's kind of any operations, surgeries. Well, back in high school, I got my ACL operated on because I tore my ACL. So ACL surgery. Any other surgery since then? No. Okay, great. All right, Mary, tell me about your situation. What medications are you taking? Well, I'm taking Synthroid because my thyroid's not working as good, and I'm on birth control. Okay, no problem. And so that's it. Okay, when's the last time you used any nicotine products? Well, I smoked when I was a teenager. Okay, so when did you quit? Did you quit? She goes, yeah, I quit 10 years ago. Okay, so quit 10 years ago. Okay, great. All right, so she's considered a non-smoker. Any surgeries? Well, I had a cesarean section when you had her child. Okay, C-section, how long ago was that? Okay, that was a year ago, 12 months ago. Any other surgeries? No, that's it. Okay, great. Okay, so I find out their income status. I find out their other stuff. I find out their health. And so based on this T-graph, I kind of figure out who's got the problem, how big the problem is, then what can I get them into as far as product. So this gives me a picture. We paint the picture of their situation. I know that Mary can't survive without his income, and Joe would be pretty tight without hers. Okay? So once I get this figured out, then I know what to do. Okay? I know what product I can cover with them because I know I can do simplified issue term with both of them because there's medications and so on. They're both non-smokers. 47, 45. Awesome. So I kind of got the lowdown. And then I go back into the pain slide, right? So I flip the chart over. Talk, okay, so Joe, let me ask this question again. So, Joe, what kind of problems is Mary going to have when you pass away? You can't give her any income. And then I explore that again. So I do it. I fertilize, soften the ground up front, find this information out. Then I go to the what if slide, and I drill it even more because I want to revisit it. I want that emotion to come out that why they're having a problem. Okay, what is their problem? How will it affect the family? Okay, and I've figured that out. So now comes proposal time. All right, hammer time. So this is what I do on the proposal side. Okay, so so now that you know that, well, I'm just going to kind of write. I'm going to jot it down here so you can kind of see what applies to whom. All right. So I go, all right, Joe, Mary. Most important thing we can do is keep you in the house, right? Right. Okay. So here's what I propose to do. All right. So, Mary, let me ask you a question, Mary. If we got you enough money, because you only make 25% of the income in the house, so if we were able to get your mortgage payment down to where it's $200 a month instead of $800, we helped you be able to get you enough money to refinance the house to where the mortgage payment's like $200 a month, $175 a month, based on your income of $8,000 a year. Do you think you could still stay in the house? Okay, and she probably do the calculations in her mind. And normally they say, yeah, I think I could swing it. Okay, great. Okay, so let me ask you, Joe, on your side of the house, I know it'd be tight for you, but let's say we were able to give you enough money to refinance the house where instead of $800 a month, it's $600 a month. Do you think it would be easier for you to provide for the kids if you we're able to drop your mortgage payment down to $600 a month because it's 75% of what it is now. And he'll probably say, well, yeah, I think I could do that. Okay, great. So let me show you an option I think could work to help you out. Okay, and then I pull my option sheets out, and this is what I'll put down as option 1. So I'm going to show you on the T-graph just so that you can see it visually how it applies to them. But this would be on the option. This is the benefit, and this is the premium, and then this is option 1, 2, and 3. So this to me would be option 1. Okay, so option 1. So what I'm going to do is I'm going to figure out, okay, what is 25% or what is 75% of the mortgage coverage for Mary? Because if I can drop the mortgage down, if I gave Mary 75% of the mortgage, so in other words, that would be basically his income, because that's, so I would, the minimum is $25,000. So I would show him an option for $25,000. And this is what I would do. Since she has the problem, the major problem, I just start with him. Okay? I want to make sure I close first on taking care of her. So I don't even factor him in until they ask me to factor him in. So I'm just wanting to go for what I know I can take care of them with minimally. And so I'm going to find out, okay, so $25,000 death benefit for 30 years, okay, and it'll, no matter what the mortgage payoff is, it'll give you $25,000. So you're, oh, I'm sorry, hold on. I'm talking $75,000. It's the mortgage. I got messed up. In other words, $75,000 for 30 years. So what can we do for $75,000? Because if she gets $75,000, she can refinance the house for $25,000, which would be, gosh, that would be $150 a month. Okay, so $75,000 for 30 years, and the premium is, let's say it's $45 a month. Okay, and then, and I say, Mary, it's $45 a month. You think that's affordable in your budget of $32,000, Joe and Mary? And if they say, oh yeah, that's very affordable, I think we could do that. Okay, great. So let me show you another option. Okay, we have a thing called an accidental death rider. So this would be option 2. So this is the the basic income. I call it the basic income percentage, which is $75,000. And then Mary, here's what we also can do is we can add another accidental rider on that. So if Joe dies in an accident, you get another $75,000. So your total will be $150,000. So you can more than cover the mortgage plus another $50,000 to help you on the income side. Do you think that could help you out? And closing question: do you think that could help you out? Oh yeah, that can help me out. Okay, so this is option 1, option 2. So this would be, let's just say that's another $8. So this would be $53 a month. Okay. Would that be comfortable in your budget? So what you did was you sold them on $75,000 plus $75,000 accidental death. Okay, and then Mary and Joe, if you wanted to cover the whole thing, $100,000 for 30 years. Okay, this is what it would be. It'd be, I don't know, $70 a month. All right. So Mary, Joe, which one of these would be the most best fit your needs and budget? I would shut up. Then they say, well, we like number 2. They pick the middle option. So they circle, I say circle the 1, they'll circle number 2. Okay? And so I start writing it up. I say, okay, let's go ahead and take care of this. Here's what's going to happen. Let me tell you what happens next. Here's what happens next. I draw the Dame Levine thing out. I say, okay, what we're going to do is here's you. And we're going to take an application and we're going to apply for this coverage to see if you qualify. What we're going to do is we're going to send it in to the insurance company, and we're going to send in the first month premium, the $53, okay, and the application. and we're going to do it electronically. If you're going to do it electronically, okay? And so as soon as I walk into the house, you're totally covered. But that $53 is refundable if they don't accept you. So right now we're going to try to get you qualified. Once they accept you, then what they're going to do is they're going to notify us, they're going to issue you a policy, okay, and I'm going to come over and deliver it to you, or they're going to send it to you, and then I'm going to come over and explain it to you, but you're totally covered, which is what you wanted, okay, and that's called an embedded command. That's an NLP Jedi Knight thing, okay, the coverage you wanted. We're going to get you the coverage you wanted, okay. Obi-Wan Kenobi, anyway. So you're going to get the policy issued, so you got your family covered just like you wanted. You don't have to wave your hand over there because you're not really a Jedi Knight. But, and then what I'm going to do is deliver to you and everything's cool. Now, if we send it in and they don't accept you, okay, where it's like X, okay, they're going to notify me about it, and then I'm going to notify you, and then we're going to put another app with another company that we have more of a chance that we're going to get you approved, okay, and then we'll get you hopefully approved. Okay, so are you good with this process? Does this work for you? Do you see any problem with this? Okay, you totally closed it here, and you closed it here. You closed it here several times, and you closed it here a whole bunch of times because you told them what the process is. Does that sound good to you? Yeah, it sounds good to me. You're off to the races. You're filling out the application. You're going on your computer doing electronic app. Now, gang, I've become a fan of electronic applications. I'll tell you what, man, electronic apps rock. And they take a little bit longer in the home, but I've got quicker at it in the home. But they rock, gang. I got this one policy issued. I mean, they're getting issued in like hours. I mean, like the next day, basically. And they let me on their Wi-Fi. So even though I have a Wi-Fi card with me, they have all let me log into their Wi-Fi with password. And so, I don't know if it's that necessary to have a Wi-Fi card because most people have it in their homes, and they'll accommodate you. In fact, I think it makes them feel like partners in this process, that they're providing you access to the internet. There's just, I don't know, there's some cool dynamic there, all right? Now, but Alex, what about Joe? Does he want Mary covered? Look, if he wants Mary covered, guess what? He's going to ask me, okay? And it may come at the end of this process. He might go, well, how about Mary? Can we get something on her? Oh, you'd like to get Mary covered too? Okay. See, I'd rather have them ask me, and they typically will ask me if they can afford it. See, I'll let this hang out there because I want to cover him first. If they want to cover Mary, okay, see, because I don't want to overwhelm them with the total price. If I just do this with Joe, I go through Mary's scenario, then the total is, $130 a month. I don't want them to freak out, right, and say, well, we got to think about it because I don't think we can afford both of them. I want them to cover their problem, their major problem, and that's covering Joe. Now, after they've spent in their mind $53 a month to make sure Mary's taken care of, Joe's thinking, you know what, I think we probably do some on Mary. Rock on, bro. So, okay. I won't actually say it like that, okay? Only if he's like a musician. But it's like, man, okay. Well, if you want me to cover Mary, let's go through the scenario with her. Okay, so Mary's, if you just want to take care of her portion of the income, then you're looking at a $25,000 policy for 30 years. Okay, and for her, that would be, that'd be $21 a month. Okay. Now, if you want to add an accidental rider on that, 25 plus 25, then it bumps it up to $27 a month. And then if you wanted to cover the whole 100,000 on Mary, that's probably more like that's probably like $35 a month. And I'm just totally guessing, gang. I don't know, but I'm actually I'm pretty good at estimating. So I'd be surprised if these weren't really close. But anyway, $35 a month. So we've already committed to 53. So I remind them that we've already got 53 on the books now. This is something that they've committed to. Okay, and I'll even say it like that. Okay, so you've already committed $53 a month for the next 30 years. How much more do you want to add to that in order to cover both you and Mary? Which one? Well, we like this one for Mary too. Okay, so $70, $80 a month. So the total, see how I'm closing it, making sure they can afford it. So the total is $80 a month. Now we know we got Joe for 53. You think you can afford another 27 a month for a total of 80 to take care of both of you? And they'll say yes or no. Well, that might be just a little bit much. Maybe we go back to that one, but they typically won't. All right. So we've rocked it because we know the situation, income percentage wise. We know what's going on with taking care of Joe first and then Mary, because Joe has, now it could be totally opposite. Joe could be disabled and his disability is only giving them 8,000, and Mary's like CNA, a certified nursing assistant, making 24,000. And so Joe's the one that has the problem, so we cover Mary. Does that make sense? We figure out who's got the major problem and we cover them first. Okay. Does anyone have any questions? Hit 4. I think it's 4 star to unmute your line. Does anyone have any questions about that? Can someone grunt so I make sure I'm still on the conference call? Am I still on? Can someone text me that?
Hey, Alex, this is Steven.
Oh, okay. Hey, Steven. Thank you.
You're on.
Okay, good. Is this making sense?
Yeah, absolutely.
Okay. Now, you can also do this if you wanted to add disability rider. It's not a big fan of disability because it's hard to get issued through, what is it? I think CFG and Foresters are harder to get issued than Forester. CFG and Mutual of Omaha are hard to get issued than Foresters. Foresters is an accident-only disability. So I would do the same thing with disability. I might add disability in here as a percentage. So it's $800 a month. We're covering Joe for $600 and Mary for $200, because that's again the income percentage on the disability of their $800 mortgage. Does that make sense? So I'll throw disability in there if they ask about it. Well, tell me about how this disability thing works, and I'll explain it to them. Say, is that something you're interested in? Oh yeah, that's something we're interested in. Okay, then I'll work in. So here, I may not put it in, but here I'll put it in. I'll put in, 600 and 200, and then I'll put here the full 800 and 800. Okay, as option 3. Okay, so we got that covered. But I covered the main person first. Let's see. Okay, so that's Joe and Mary. So let's talk about mortgage payment protection. This is where you got to get good at the mortgage payment protection because a lot of older people are getting covered with mortgages. Okay, so let's redo the scenario from a final expense standpoint. Let's just kind of erase everything. And let's talk about this from a final expense perspective and show you kind of what I've been doing there. So I do the T. Okay, I put Joe, and he's 68, and Mary is 65. Okay, and what I'm looking at is, so Joe and Mary, what's the total income coming into the household? And let's say it's $24,000 a year. Okay, so you're both retired, getting the Social Security and pension. Yeah. Okay, so Joe, of the $24,000, how much are you bringing in the home? And let's say it's like 18,000, and then Mary's is the remainder, which is 8,000. Okay. All right. You know what? I'm sorry. This is mortgage. This is a mortgage. this is a mortgage sale. So let's say their mortgage is $80,000 mortgage. All right, and I find out it's a 30. Yes, they're getting 30-year mortgages, getting at 60, and their mortgage payment is, let's say, $600 a month. Okay, so this is on one of those the older folks that are getting mortgages. All right, on expense, I do the same thing, but I make it. That's not as but you got to get good at mortgage payment protection. So I say, okay, so it's $600 a month. This is the kind of the breakout of 24,000. So this is like 30%. Again, I put it in parentheses, and this is 70%. Look, and you got to take your calculator out. I could do this in my head. I do it in my head. I'm just approximate, but take your calculator out and then I round it to an easy number for both of them to understand. So here's roughly 70%. I think that's right? Because 8 times 3 is 24. So 8 times 3 is 24. So this is 33%. I'm sorry. And this is 66%. Okay, you guys got it? So it's about a third and 2/3, a third and 2/3. And I say, okay, so I go through the same scenario. So Mary, Joe, when Joe dies, how much of his income goes to you? And they say, well, like for example, does the pension have a survivor benefit? How much of the Social Security comes home? And so let's say he's got $1,000 a month in pension. So let's just say another, let's say $800 a month goes to her times 12. So that's what, 86. That's 96, 9,600. So you had 9,600. Right, 800 times 12. So that's 17,600 a year. Okay. So how much did her income drop? From 24,000 to 17,000. So I'll take my calculator. I figure out what the percentage is. So like, gang, yeah, you gotta get smart, man. This is where your math comes in handy. That and we're just talking basic adding and subtracting. So 17,000, and I kind of like to be exact one, so then I can round it. Divided by 24,000. Typically, it's not that good. So the income goes down by 27%. So let's just say the income drops about 27%. Okay. So let's say it's 25%. So Mary, based on this income per year, if we can get the mortgage payment down to like 20%, 27% of 600 is $162. I see 600 minus 162. $438 a month. Would that be all right? Would you be able to make your house payment if we drop it down to around, let's just say $400 a month? Would that work for you? And we'll close it right there. It's just say, well, yeah, I think that would work out. I think, if this is the case where I'm making 17, I could probably make it on 438. But what if we just did it, we cut it in, so drop down by 27%. Okay, great. So here's my scenario with her. As I look at covering Joe, and I take 27% of the mortgage. And I'm telling what I'm doing. So Mary, this is what I'm going to do. Let's just take 20% of the mortgage times 80. And if we can cover that much, which is 21,000, okay, 21,600. If you've got 21,600 and we refinance the loan, you think you can make that mortgage payment of about 400 a month? You say, well, yeah, probably good. Okay, great. So what I'm going to do with Joe is I'm going to find a 68-year-old. What can we do on a 68-year-old, gang? We would probably do final expense, I believe. Okay. So what I might do is I might show them maybe a final expense of maybe it's 15,000 whole life, and then another 15,000 accident, which I think on a 68-year-old we can do accident with. If it's not a rider, we can do it with Foresters. Okay, so this would be an accident death benefit. Okay, and then this is the price for that. Okay, so let's say, I don't know, maybe it's $95 a month. And what I'm going to do is I'm going to try to close them there. Because so what I'll also show them is Mary, like that 80,000. Okay, Joe's 67. 30 years from now, it's 97. Okay, so that 80,000 goes like this. Okay, I'll draw a graph out. So this is 80,000. Okay, so usually 60, 70. By 87, there should be 40,000 left. Okay, because usually 20 years into a 30-year mortgage, they've got half the payoff is left. Okay, that's how the curve goes. So that's sort of the rule of thumb, gang. Okay, at 20 years on a 30-year, it should be half. So it's 87. So I'll show how maybe 30,000 can pay the whole thing off, but maybe if they get if they're getting 30,000, the longer he lives, the smaller this gets. Is my point. So I'll kind of show them graphically what that means. All right. Now another thing I might do is I might show him a 10-year term policy that goes to 77 that will cover, let's say 15,000. We do whole life, and maybe we do another. I think a 10-year term is 100,000. Depending on it, I might do a surety 350 plus at 100,000 for 10 years. Okay, just to give them a little something, a bigger chunk during the first 10 years, and then a whole life that'll go through the end. Okay, something smaller but go through the end. All right. In fact, that's one of the scenarios that I did. When I try to get, this established that we can get her covered, and that's how I'll do mortgage payment protection, or I'll show how she can cover some of the mortgage. Now, another option is mortgage payment protection. Is let's just do 10,000, and that'll cover your mortgage payments for 672. So this is like maybe 14 months. So 14 months of mortgage payments. Okay, and one of the questions I'll talk to them about is I'll ask them, so Mary, do you think you're going to want to stay in this house after Joe's gone? Or do you think you're going to want to downsize into a smaller single level condo? Is that something that's more realistic for you? Do you see yourself going up and down these stairs when you're 75, 80? When they say, well, I really don't, I probably want to downsize. Okay, great. So maybe if we just get you enough money so that you can sell the house, not take a loss, and be able to stay in it for 14 months. You think 14 months is enough to sell it at a good price? You can get equity out of it. Use that equity to put a down payment on a kind of a smaller ranch-style condo. Okay, so here's where you start doing mortgage payment protection, where covering their payments will give them enough time. Because a lot of it will, do you want to stay in the house? Okay, does that make sense, gang? Does anyone have any questions? Like, I'm going a little bit longer than I wanted. Does anybody have any questions on the mortgage payment protection?
No, it makes a lot of sense.
Okay. Okay, let me show you one more thing. And this is if you have someone this is kind of called the term conversion strategy. So you're sitting down with someone, and they have like a 10-year term policy that either you sold them 10 years ago, and it's or not 10-year term, like a 20-year term, they got 10 years left on it, and you sold to them 10 years ago, or someone else sold it to them 10 years ago, and they're a little worried because they're only they're 67 now. 10 years from now they'll be 77, and they still might need more insurance. They don't have it. Okay, and so here's I'll talk to them about this. So what I'll do is I'll draw it out. I go, Joe, okay, let me show you. Let's kind of figure this out. Let's kind of draw a graph out here. Okay, you're 67, and this is age 100. Okay, maybe you won't be around. Maybe you'll take 100. Hope, but now the term policy you got at age 57 is a 20-year term for 100,000. Okay, so 10 years from now, 77. Okay, so this is like not to scale, but what you're trying to show is that there's shorter amount of time when his 100,000 stops. Okay, that's 100,000 of coverage. He's only got 10 years left on a 20-year term. He's only got this amount of time left. And so there's more, so visually you see more here than here. So I go, so Joe, tell me, what do you think you're likely to die? In this period here, in this period here? Okay, you don't have to emphasize it like that. But where do you think you're going to be most likely to die? And what he's going to do, if you draw it out right, he's going to say, well, I'm probably going to die somewhere out here. Oh, okay. Like, how old was your mom when she passed away? How old was your dad? Try to find where there's longevity in the family. Well, my mom lived to 85. My father lived to 90. Oh, okay, so you have longevity in your family. All right. Okay. I said, oh man, so if you think you're going to die here, you've got a problem, don't you? He goes, well, yeah. You're going to probably are you going to need insurance? Some kind of insurance out here? Do you think, is your mortgage, do you think you're going to have your mortgage paid off before 77 or after you're 77? We just refinanced a 20-year mortgage, so it'll go to 87. Oh man, we got a problem, don't we? Okay, so Joe, let me make a suggestion. Most of my clients that have had term policies at your age ask me this question. This is my recommendation to them, and they all like this advice. So let me tell you what I recommend to them. What most people want to do is they want to implement this strategy. And the strategy is maybe, and how much are you paying for this $100? We're paying, or this 100,000. We're paying $125 a month. Okay, cool. So here's what you've established. Right now, their budget that they're already paying for life insurance is $125 a month. That's already going out the door every month after month. They've learned to live without that $125 because they have the peace of mind of 100,000. But that's coming quickly to an end. And I set it up like this too. I'll say, Joe, man, where'd the last 10 years go? It's a perfect setup question. Joe, where did the last 10 years go? It flew by like this, right? Yeah, it did. Do you think the next 10 years, when you're 77 and you know that next month your policy is going to terminate, are you going to think the same thing? Where did those 10 years go? Oh yeah, I am. And if the next day you have no more life insurance, are you going to think back to that day that I was here? And you might be thinking, dadgum, man, I wish I went ahead and did what Alex said and implement this recommendation, right? And you totally set them up, man. I mean, because when you think about it, how fast did the last 10 years go? Like 10 years ago, my daughter was 8 years old, right? Now she's going to college. It flew by like that. So you just tell them something they already know, but you give them that feeling of down the road, they're looking back. Again, another strong NLP thing called future pacing is, man, 77, you look back and you didn't want to have the pain of regret thinking that I woulda, shoulda, coulda back when I was 67, got that policy when it was cheaper. Okay? So that's how you set it up. Did that last 10 years go by quick? Yes. Okay, so here's my suggestion. Why don't we think about getting something like maybe 50,000? I know it's half of 100 that will go all the way to the end of your life. And in fact, we'll grow a cash value in it so that you're earning money in a cash value. I may not show it all like that. I mean, you're growing some cash value in it too that you can take advantage of if you're in a bind. Take 1,000, 2,000, maybe you borrow 2,000 out of it and go on a trip around the world. You know what I mean? But you got this going out, guaranteed the rest of your life. You never have to worry about insurance again because you've got it already locked in place. And you know what? 50,000 for the next 33 years is only $170, $175 a month. Again, I'm just guessing at these numbers, but it's going to be something close like that. So you do so Joe, for an extra $50 a month, you have the peace of mind knowing that Mary will have $50,000 tax-free to be able to take care of the mortgage, take care of final expenses, take care of everything that she needs to take care of when you're gone. For an extra $50 a month. See what you're doing? What you're doing is you're saying, for the benefit of long-term insurance, you don't have to worry about it anymore for only $50 a month because they've already spent $125. You're just saying for an extra, for just $50 a month, you have this peace of mind for the rest of your life. So is that something that you think you'd like to do? Yes! Woo! All right, so you replace that one, or you actually convert it. If this is one you wrote, you can convert it. You still get full commission on the full $175 a month when you convert it to a full-time plan of insurance. Okay? Does that make sense, gang? Drawing pictures, people, not everyone's visual, but drawing pictures makes sense to them because it makes sense to you. It makes sense to you because you're drawing it out. If it makes sense to you, it's going to make sense to them if you do it pictorially, I believe, anyway. Does anyone have any questions on that? Make sense? All right. All right, gang. Those are some proposal strategies I think are winning strategies for you. I think it'll help you out and, man, help you rock the house. So let's put the hammer down, dial that phone, right, and make the commitment to come out to the Leadership Conference in July. You're going to learn this kind of stuff and more that'll help you learn to make a ton of money with us, all right?